Hi, my name's Tom Alabaster, and I'm the head of the private funds group at Rips and Gray in EMEA.
Hi, Tom. I'm Jeremy Dennison. I'm a partner and the General Counsel at Livingbridge, a UK mid-market buyout firm.
So we just finished up a panel on fund formation, regulatory compliance, and everything related thereto. What did you think the main themes were?
Well, I think before getting into that, I really thought it was an excellent panel, particularly sitting on it as an M&A lawyer, not a fund formation lawyer, and at a GP that's not currently in the market. So it was something that I could listen to and learn from, and that's something I absolutely did alongside some of the other GCs that are on the panel with us. I thought it was really good. I thought it drew out some of the key themes that I've been observing. Clearly, our ears to the track for when we do go out and raise our next fund, and it absolutely resonated what people were saying around the challenging fundraising environment. Maybe that's something we can touch on a little bit. The different sources of capital, and certainly, we get inbounded by those platform providers. We're thinking more about extending beyond our traditional pools of capital in Europe and the United States. And then we touched on at the end around technology, and that's something again that I think is going to really drive efficiencies within our business.
I thought it was really interesting that notwithstanding there are all these different areas for formation of funds in Europe, Luxembourg remains dominant, and that people were talking about that Luxembourg platform, the complexity of operating it, much more so when you are a London-based asset manager with most of your substance here in London. But that still seems to be the prevailing structure, with the SCSP, the limited partnership, being the primary vehicle without any RAIF wrapper or similar. But notwithstanding that people were still exploring other structures. I mean, you were talking about always using a UK limited partnership. So it's interesting to see that notwithstanding everybody talking about Lux, people are using other types of jurisdictions.
Yeah, and this is something actually that I probably can talk to a little bit. As you say, we're probably slightly unusual in that we have a UK GP and manage UK domiciled funds, but we do periodically look at other structures and whether we need to be thinking about domiciling our GP or our funds in Europe or elsewhere. And so we do that exercise probably once every 2 or 3 years to look at the options. And the last time we did it was about 18 months ago, and specifically weighing up Luxembourg as a possible destination versus Ireland. And actually probably in line with a lot of what the panel were saying is that Luxembourg is still the destination of choice. People still talk about the administrative burden that it introduces. People talk about how expensive it is, and people talk about the regulator and in some ways how fastidious they can be on certain matters. But it's really clear they have a very knowledgeable and skilled worker base. It's a well-trodden path. The advisory community is very well established. So versus Ireland, where it's a bit more nascent, it's really only since 2021 when they brought in that new Irish Limited Partnership Act that it's established itself as a credible destination for private equity. And so I think a lot of people, certainly in this arena, whilst we may be innovative in others, it's probably more of a wait and see strategy, see who moves first and how it works for them, how the regulator responds, how the advisory community builds up. And then possibly you might start seeing more people looking at Ireland as a genuine alternative to Luxembourg.
We spend a lot of the time evaluating Ireland. I think we've done 2 structures that have ended up being Irish limited partnerships. But I think with the fundraising market as it is, there's been a reluctance to add another new element to a fundraise. And so if you have a Luxembourg fund, you stay with a Luxembourg fund. Mm-hmm. You don't say to an investor, oh, by the way, we've also moved it to Ireland. It's just another thing they have to get their head around.
Absolutely.
So as fundraising improves, potentially we'll see more Irish structures. Because there's a lot of good service providers in Ireland and a good model, law and regulation that could be used quite well, I think.
And
Over
cultural
time.
alignment. So, they speak the same language
Yeah.
that we do. It's very easy to get there. So there's lots of, I can see lots of positives for Ireland, but I absolutely agree with you. And that's where we ended up actually in terms of, we will, barring a big change, stay as a UK manager, UK funds.
Great. So we also talked about continuation funds and co-investments and the prevalence of both of those structures. I mean, maybe taking co-investments first, it seemed like there was just an abundance of co-investment on offer, and that all of the panelists were experiencing and having opportunities to deploy co-investment strategies.
Yeah, and I think that goes to a broader point that has been raised on a number of panels, which is this is in part about reducing the fees for limited partners, and it's also giving them optionality and more choice around where they deploy their capital. So it's a very effective means of doing that from an LP perspective. And from a GP perspective, it's very helpful too, because it enables us to right size our checks and therefore opens up a broader range of investment opportunities, irrespective of fund size or concentration limits that you're facing. So from a GP perspective, we like the flexibility they afford, and from an LP perspective, it enables us to actually make strategic decisions around co-investments with a view to future fundraising. So it's a really interesting innovation in the market, or less an innovation, more development in the market. And it is very rare that we will talk about any new deal without contemplating the extent to which we can offer co-investment on it. And even often, actually, when the fund could carry the whole check, but we see it as an opportunity to bring in an investor, possibly with a relatively small co-investment slice.
I think that's right. I mean, it's a good way for a co-investor to get to know a manager as well, to understand how you do a deal, to educate themselves on your process and how it works for you. I think it's also, as you said, a great way to blend fees and to get a different fee profile across a manager that you're investing with as an investor. I think the other thing that's interesting is the development of actual dedicated co-investment teams, particularly within fund of funds, super sophisticated groups of individuals that all they do is co-investments, and so they understand them from soup to nuts.
Yeah.
And so you have this dedicated source of capital that is looking for those types of investments, which the GP can then dialogue with.
Right. So your sovereigns, they really like it. Actually, interestingly, some of the aggregators, some of the private banks, for example, who are giving access to their high net worths into private equity, they quite like this because when you're coming into the primary fund, of course, the manager's charging a 2.20 fee on that, and therefore they're relatively constrained in the additional fees they can layer on to their high net worth clients. If they have a co-investment program that enables them to come into the private equity transactions on a fee-free, carry-free basis, actually that gives them an ability to charge a slightly higher rate to their end client. So it actually, both from the conventional LPs, your sovereigns, and your platforms, they like the co-invest solution.
I think that's right. And CVs, continuation vehicles. I mean, the panel was saying that universally within Europe, they're seeing an increased use of CVs, increased familiarity in the market, some specialism developing both with law firms and with banks on how to do them, and a broader sense of comfort, I guess, with doing a continuation vehicle. I got a sense on the panel that where managers have deployed continuation vehicles, existing investors are still cashing out rather than rolling. That most of the continuation vehicles were single asset.
I mean, that's a really interesting observation because we haven't executed a CV, but it's something we think about certainly much more than we used to as an exit strategy. So I rely on what advisors tell me, and it isn't always a consistent message that I'm getting across. Certainly everyone's saying they're seeing more of it, and the facts bear that out. In terms of what it looks like, I think you chat to anyone, they will say 5+ years ago, these were multi-asset vehicles, often the kind of tail end of the fund to provide a solution at the end of life. Whereas evolved to very much this is the star asset in the fund. We want to find a way to continue holding this. It gives an optionality for the LPs, and you can re-incentivize the team at the GP around a CV. And actually, what some of the advisors have been telling me now is you are seeing a lot of that still, but you're starting to see more multi-assets again. And the driver for that is different to what it was before. The driver being actually LPs are looking for a little bit more diversity. And a bit more of a sort of blended profile in terms of liquidity. And so if you can construct a CV that is still made up of really high quality assets with slightly different exit horizons, different sector approach, but still excellent businesses, then that's a more marketable proposition to the LPs than the single asset on its own.
Yeah, I think that is right. And I think it also changes the economics, right? And there's the opportunity for some GPs to have a super carry if they hit certain hurdles, etc. So I think there's a lot of evolution to be done in the space, but I think there's a lot of technology there now, which is, incentivizing GPs in different ways, particularly with particularly stellar assets. Sources of capital we talked about as well, didn't we? We talked about the diversity of source of capital and the movement away from US, well, not away from, but in addition to US and European capital, adding Middle East, South American. That's also been your experience?
Yes. I mean, again, these are based on conversations that we're having with advisors, but very much so those traditional pools of capital, the track back 5 years, when you went to raise a fund, you were largely relying on existing investors re-upping into your strategy. We know that it's capital constrained right now, so I don't think any GP is sat there thinking, I can just tap up my existing investor base and they'll re-up to the same level plus of it, and that will get me to my new target. So people are having to think a bit more about where they're getting their capital. So that's geographically. Are they looking to Asia? Are they looking beyond Europe? Are they looking at Latin America? But also the type of investor. So opening up those high net worths, as we discussed, those retailization channels. And even some of the LTIFs and LTAFs that you're starting to see come through, do they provide viable solutions to bringing capital into private equity?
Yeah, the discussion on the feeders was an interesting one. It seems like people are using quite a few private banks to feed some of the high net worth or ultra high net worth money into the funds that they're raising, and also the use of iCapital and various distribution arrangements. It's become a whole industry in itself in order to source that capital. So a really interesting new development within the...
It is, although I would say those high net worth platforms are something I think that have broad appeal across the spectrum. Certainly sat as in a mid-market GP, and what I'm being told about some of those genuine evergreen and retail structures, they're very burdensome, very intensive, labor intensive, cost intensive. So whether they provide a solution right now for the smaller managers, I think is an open question.
I think that's right. I mean, whenever we've done an open-ended product or an evergreen product, the people that spend the most time with us on the phone are the people in operations to try and understand actually how they run these schemes and how they run these products. It's a much more complex beast, and I think not to be approached lightly. And you have to bring your back office, your operations team, your finance team with you when you develop those open-ended products, because I think it can be underestimated as to how difficult they are to operate.
Yeah, but and sort of stepping up a level and touching on a broader theme, GPs are tapping these alternative sources of capital because the traditional sources have been less prevalent. And I think we'll just see this migration of capital between asset classes and geographies as well. And so it's really interesting to me to observe what's going to happen over the next 3 or 4 years as the sort of geopolitical picture evolves. So I think certainly the last 2-3 years, LPs have probably been net sellers of Europe. I think that might change. I see Europe actually as a destination, almost a safe haven destination. If you've got the US outperformed for a long time, is it due a correction? Possibly. And similarly from Asia, looking to diversify into different geographies. So actually Europe might be a beneficiary of that. And then you might see actually it's if it's easier to raise capital in traditional means, what does that mean for some of those alternative and at the moment more challenging channels? Do they become less prevalent? It's an interesting question.
Completely agree. And all of this complexity brings with it extra operational hurdles. So we were talking a bit about operations, the beefing up of teams internally, the use of service providers, and the use of AI. So, I was wondering what your thoughts were on that to sort of bring us, in summary, to a close.
Yeah, and I see that as sort of being one-way traffic. So it's part of that institutionalization journey that private equity has been on for a long time. The deals are more complex than they once were. That's both in terms of when you're buying the business, when you're managing it, and when you're eventually selling it. And then the regulatory burden is going one direction. And then the raising of capital, as we've touched on, there's many more channels that you're having to contend with. So all of that brings complexity that needs to be managed internally by the GP. And you need the capability and the capacity to do that. And so you're seeing those operational teams build out their capability. So a lot of smaller managers that would previously have had a very lean operational team and most of the headcount and cost being on the deal side are having to swallow that pill and increase the overhead on the operational side. They're having to bring in lawyers, and lawyers aren't cheap, as you know, Tom. And they're having to bring in sophisticated IR capability. They're having to bring in, same on the finance side of the business. So you're seeing this professionalization is increasing costs, which then is the driver for efficiency. How do you get more bang for your buck when you're having to pay more for that capability? And technology's got to be one of the answers, and particularly AI. So I think you'll see a lot of private equity firms looking at how they can use AI so that they can keep that senior layer of people, but get a lot of that sort of grunt work, if you like, done efficiently and effectively by the AI, so that it keeps those people freed up to do that really value additive work.
Yeah, it seems like AI in the most immediate will be around process, right? Being able to look at 20 different LPAs and work out if they're consistent on a point that an investor's raising. Being able to automate a side letter so that if you know what the investor's going to ask for, you can produce that side letter in a couple of minutes rather than having someone have to spend a number of hours doing it.
Absolutely.
It's around that process efficiency point.
That's the lowest hanging fruit, and that's where we're already seeing gains. Certainly at Livingbridge, we're deploying AI to do things like write the board minutes for meetings. We're using it on a compliance side as a triage for expert network calls. There's already use cases that are coming into the business. You still need that oversight from a human. And you're certainly not at the point, I don't think, where you can rely on an AI product or an AI solution without that level of human oversight. But as an efficiency tool, it's already starting to prove its use.
Completely agree with that.